Now, with the Europeans on May 30 deciding that they were going to go ahead with an oil block, that is going to make about 2.5 to 3 million barrels of Russian crude homeless. That's a big deal.
Mm.
So we're only now getting to the point where there's significant, permanent reductions on Russian output. And if that holds for just a few weeks, pressure will build up within the Russian system through their pipes all the way back to the wellheads, and they're going to have to shut it in. And as a rule in the permafrost, once you shut it in, that well is now never going to be turned on again because you get cracks throughout the system from the pressure builds. This is the permafrost. It's problematic in many ways. That crude doesn't come back. And the only way that the Russians were able to bring it back after the post-Cold War collapse was by bringing in Western technicians who are no longer available. So at some point later this year, we're looking at somewhere between 3 and 6 million barrels of Russian and Kazakh crude just falling off the market and never returning. That's not priced in yet because it hasn't happened yet, but we'll get there. There's so many things moving, it's hard to put a number on the price. If this had happened very, very quickly back in March, we'd probably be talking about $170 crude. That might be a little bit high now because the Chinese have partially gone offline with their lockdowns. We've had a little bit of demand destruction. We've got the shale sector accelerating their output. They're probably going to be able to kick another 1.5 million barrels into the system before the end of the year. That suggests that 170 is probably a little high, but 150 is still a good kind of stake in the ground.
Mm.
Probably. The energy price is very fuzzy. And it's happening at the same time that we're losing the baby boomers' investment capital. So dealing with it is going to be inflationary on its own from a financial point of view. Every time the United States does something that some country finds annoying, everyone talks about the end of the dollar. But if you look at what has happened with the sanctions on the Russians so far, the Europeans have basically ceded their position in international currency control to the United States. And that means that they've joined in with the Canadians, the Taiwanese, the Koreans, the Japanese, the Australians, the Kiwis. There's only one currency anymore. And everybody really only has one place to go. Because if you look at the demographic structure of the world, the United States has the millennials. That's a consumption base now, it's a production base for the future. That's great. If you look at most other countries, they don't have that class. So the tools you would normally use to shape monetary policy, primarily interest rates, do not work in a society where there isn't a lot of consumption. That's what you're trying to regulate primarily with interest rates. So the US Fed can still do that. Most other countries cannot, which means this tightening process that the Fed is going through is making an ever larger delta in terms of interest rates between the United States and everybody else. And currency markets are adapting appropriately. We've got $2.5 trillion in negative sovereign debt out there, and money is just flooding from that into the US dollar. So for the next several years, you should expect the dollar to go nowhere but up. Maybe not in a straight line. That would be way too convenient. But this is the future for at least the next half decade, probably more than that. Because remember, over the course of this decade, we're going to see a lot of demographic implosions, first and foremost in China. And that capital, once it has a chance to run, is going to run to someplace with rule of law and a lot of liquidity. First and foremost, you're talking capital flight. During COVID, that was probably a little over $2 trillion a year. It's certainly going to increase. That is going to make it even more difficult for these countries to adapt to the changes in supply chains and demographics and economic norms. The second big thing, of course, is the debt market. There were a lot of countries, especially in the developing world, that took out huge volumes of debt in the 2010s when the US dollar was relatively weak to the global norms. We now see the other side of that. And you should expect a series of not just currency crises, but debt crises in at least the majority of the countries out there. And that is also unavoidable at this point. It's a question of what's the difference between the financial economy and the real economy. And there's definitely something to be said. As a rule, when times get tough for the average American, whether it's because of inflation or disease or war, whatever it happens to be, the Federal Reserve just ignores whatever the financial system wants and focuses on the real economy. We're not there yet. We'll probably get there next year. There's only three parts of the American economy that are internationally linked at all. One is tech manufacturing. That's all in East Asia. A lot of that's now coming back. Number two is agriculture, because American farmers and ranchers are just so hideously productive that they have to export about 1/3 of the calories that they produce. Finance is the only other one. And if there's one thing today's Democrats and Republicans agree on, it's that the financial world is not a group they speak for. So the political support that might have existed during the W administration or the Bill Clinton administration, that's gone. And we're looking at a system now where the government is going to be focused on the real economy, and what financials happen, or what the financial world does with that is what the financial world does with that. Now, with all the capital flight coming in, I don't think it's going to be quite so bad as you think. But there are going to be a lot of debt defaults that just have to be sucked up. Anticipating a conflict. I mean, the U.S. certainly doesn't have an interest in a war in the Western Pacific right now. And when the Chinese look at what's happening in Russia with Ukraine, they realize that every bit of their plans for Taiwan have proven incorrect. The international community did not just accept the deal. The war was not over in a week. And the concept of boycotts, that individual consumers could actually shape corporate policy, wow, the Chinese have no frame of reference for that at all. So I think actually the risk of a war of China trying to take over Taiwan has dropped. The sanctions proofing, that makes a lot more sense. The Chinese are discovering that sanctions really can hurt a major country that happens to be a food and oil exporter. Can you imagine the damage for China, which is a food and oil importer? They're concerned that if these sanctions were put against China for whatever reason, that would be the end of China within a year. And they're right. There's only two things you can do in that circumstance: stockpile so you can buy more time, or fundamentally change your foreign security output so that sanctions don't happen because you are no longer perceived as hostile. And because the Chinese no longer can adapt their policy, because there's only one guy making all the decisions, trying to sanction proof is all you can do. It won't work. China imports 85% of its energy and 85% of the inputs to grow its food. So the most they can do is buy a few weeks. But what their system is, as it is right now, that's the best case outcome. Just make sure you don't take demographics as a factor, and that's everything. They feed into the picture. So a good example, two good examples are Mexico and India. They were relatively late to industrialize, and so their birth rate collapses happened later than they did in, say, Russia or China. If you look at the demographic pyramid for India, it goes down from the top as a pyramid like it's supposed to. Then you get to about the 30-year-olds, and then it goes straight down. So the birth rate bust that hit the advanced world also hit the advanced developing world just 30, 40 years later. And if anything, the birth rate breaks in the advanced developing world are faster and harder than what happened in the rich world. In order to make that demographic dividend stick, you have to be able to have an industrial system that takes advantage. In this, I think India overall is going to do fine. They're putting the capital in the right places. They're diversifying their manufacturing base. What they're doing is a little bit of an echo of the United States as regards China. And I think that's going to do very well for them moving forward, especially since they're the first stop out of the Persian Gulf. They'll probably never even have an energy crisis. Energy pricing, different issue, but not a shortage.